We are continuing with 2020 grade 11 accounting. This would now be question 6. We originally called this question 3. As part of your revision exercises, you would see there's a question 3, a question 4, a question 5, and then it reverts back to question 3. I renamed it to question 6 for simplicity purposes. In this partnership, we are required to first do 6.1.1 and then 6.1.2 and 6.1.3. This video is going to be divided in 2 parts, 6.1.1 and 6.1.2, and then we're going to do 6.1.3 in a different video. So this is part 1. In this case, we need to say which one of the following is which, either business entity, historical cost, prudence, matching, materiality, or going concern. The first one, trading stock is reflected at 23,500, but will sell next year at 35,250. We can match that to the Prudence Concept, which says the assumption is that your financial results are presented in a conservative manner, even a pessimistic manner. So we're not going to consider next year's stuff. We're going to show it at this year. So we will show it at 23,500. That will be our Prudence Concept. Next one, postage stamps of 250 is recorded in sundry expenses. Well, if people still use the postage these days, that is a good thing. But for this people, that would be the Materiality Concept. The Materiality Concept states for us the following. Disclosure of items which are important to the readers of financial statements. Only material items are shown in the financial statements. I do not think postage stamps will qualify to be shown separately. So that would be material concept. Next one of the partners receives 1.5 million rand and it's not recorded in the business books. So that would be the business entity concept, which states financial affairs of a business is kept separate from the financial affairs of the owner or the owners in this particular stage. So in this case, it will be business entity. Then partnership has purchased equipment, dental equipment for 1.7 million. Technology is changing rapidly. The equipment will be useless to anyone in the future. Therefore, the partnership decides to depreciate it over the useful lifetime of 8 years. So that would be next year they're going to do this, then the next year after that. So for 8 years, they're going to do that. So that would be going concept. Financial statements are prepared on the assumption that the business will continue operations in the foreseeable future. So that would be going concern. Then thereafter, income statement will reflect telephone account with amount paid for 11 months and 1 month accrual. That would go to matching concept. That is, if an expense has been incurred with the effect of producing an income, the 12 month hasn't been paid yet, but it should be there because it has been incurred already. Then these two items must be matched against each other in the same set of financial statements. So the matching concept. All financial transactions up to and including this date must be reflected in the financial statements. Therefore, in this particular one, we'd write there, matching concept. Then land and buildings, it's recorded in a balance sheet for 300,000 for the past 5 years, but it was recently appraised at 2.3 million. However, according to our concept, assets will be valued at historical cost. So we're going to put this land and buildings still at its old cost. So that would be historical cost. That takes care of 6.1.1. Next one, the general ledger. We're going to do the appropriation account. In the appropriation account, if we take a look at the information, they give us the capital accounts. They give us some additional information. I am not sure about this particular part. I do not think it should be included in here, so I've crossed it out. If you take a look at the calculations in that, then this sentence here does not fit. Let's go through it and see what's happening. On the 1st of September 2014, which was halfway through the financial year, because our financial year ends at 28 February. And the 1st of September is 6 months into, up to and including September, October, November, December, January, February. That's 6 months. So for those 6 months, they equalized their capital contributions to 1,750,000. So let's do the first one, provide for interest on the capital at 12% per annum. Now we have to take into account the adjustments for the capital contributions. We have to calculate Regis interest on capital, but we now have to calculate actually both of them, both West and Reach. Let's go and take a look how we would calculate that. To calculate the capital contribution, we would write West on this side, and we would write Reach on this side. West had a capital contribution of 1,500,000 for the first 6 months. Reach had a capital contribution of 2 million for the first 6 months. So for the first 6 months, all of them get 12% interest. Times 6 over 12 there, times 12 over 100. So for West, times 6 divided by 12 times 12 divided by 100 gives us 90,000 for the first 6 months. Reach, the same. 2 million times 6 divided by 12 times 12 divided by 100 gives us 120,000 for the first 6 months. That was for the first 6 months. For the second 6 months, both of them now only has got 1,750 times 6 over 12 times 12 over 100. And this is side as well, 1,750 times 6 over 12 times 12 over 100 gives us, so it's 1,750,000 times 6 over 12 months times 12 over 100 gives us 105,000 for both of them. You have to calculate Regis capital for the year, then that would be the 120,000 plus the 105,000 gives us 225,000. This particular one would be 90,000 plus 105,000 gives us 195,000. So that would be the interest on capital for the year. All that we need to do is to go and complete the interest for capital. So we've got there the 90,000 plus 105,000 plus 120,000 plus another 105,000. That in total gives us 420,000. That is for the interest on capital. Next one that we need to calculate is the monthly salaries. West is 60,000 for 12 months. So West would be 60,000 for 12 months. For 12 months would give us 720,000 rand. Then Ridge earned a salary of 75,000 per month for 12 months. So that is 75,000 for 12 months gives us 900,000 rand for those 12 months. Next one, each partner earned a bonus of 20,000 rand each. So the bonuses would be 20,000 plus 20,000 would give us 40,000. And then all that's left over is to calculate the secondary distribution. Now it says there, remaining profits shared between West and Ridge is 223. West's share of the remaining profit is 420,000. So we need to go and calculate Ridge's part of the profit. So we've got here current account West, and we can write in current account West. Let's go and do the calculation. The calculation says 2 to 3 is the ratio. West got 420,000. So we need to calculate how much that part is. What we can do, we can bring this down to 1. So we can say to 1. And how do we get from 2 to 1? We divide by 2. So we can take the 420,000, divide that by 2, gives us 210,000, but we want to get it back up to 3. So we can multiply that with 3. So we're getting to 630,000 rand. So West would get, as indicated, 420,000, and Ridge would get 630,000. All that's left is to balance the account. And remember, this comes from profit and loss. Now, we don't know what the value is, so this is going to be a balancing amount. How do we get the balancing amount? We're going to add up all of this, so 720,000 plus the 900,000 40,000 plus the 420,000 plus 40,000 plus 420,000 plus 630,000 gives us 3,130,000. Both sides need to add up to the same value. So that would be 313023. And in turn, that value then would be the balancing figure of 3,130,000. And that concludes the first part of the question for partnerships.